The story of the collapse of the hedge fund long-term capital management, LTCM, is recounted in Roger Lowenstein's book titled When Genius Failed. The fund was run by geniuses with Nobel Prizes in economics and PhDs from Harvard. One of them, Myron Scholes, gave his name to the formula for valuing options. Another LTCM trader had 2 degrees from MIT. They were scholars who thought they had invented computer models that were so clever they could predict the future. But they were wrong. Their genius failed. LTCM was formed in Greenwich, Connecticut in 1994. At its peak, the fund had amassed over $120 billion in assets, while its derivative positions amounted to over $1 trillion. But in 1998, it was on the brink of collapsing into nothing. LTCM was founded by John Meriwether, former head of bond trading at Salomon Brothers. LTCM's strategy was based around fixed income arbitrage. This took the view that over the long term, the prices of long-dated bonds, issued a short time apart, would become identical. On issue, there was generally a small spread between their prices. LTCMs sought to profit as this spread converged. So they bought one bond, went long, and simultaneously sold the other one, went short, in gigantic quantities, mostly with borrowed money. If the bond prices behaved as they hoped, the profit on one bond was always greater than the loss on the other. Even though the profits on each single trade were tiny, the huge leverage meant they were multiplied 1,000,000 times. In the first 3 years of its operations, LTCM averaged returns of 40% per annum, and the fund's managers became heroes. When times were good for LTCM, all the investment banks wanted a piece of the action. They pushed to lend the fund more capital with which to trade. They competed to earn commissions from clearing LTCM's trades. But in the end, they were asked to step in and save it from destabilizing the entire financial system. Like all hedge funds, LTCM aimed to make money in all market weathers. However, in 1998, the global economy became stormy after the Russian government defaulted on its loan repayments. Investors panicked and sought the safety of buying U.S. Treasury bonds in huge quantities. This threw out LTCM's trading models as bond prices diverged. LTCM lost nearly $2 billion of its equity capital. The LTCM debacle was an example of quantitative trading strategies going wrong. The Nobel Prize winners and PhDs designed computer models that were thought to be able to predict the future with absolute surety and safety. Just as the defaults of subprime mortgages in the U.S. has triggered a global financial crisis in 2008, so was the demise of LTCM triggered by events in Moscow, a long way from its headquarters in Connecticut. The book charts a chronological course through the history of LTCM, from its start-up through its ascendancy to its fall and implosion. It explains in simple terms the complex relationships between bond prices, interest rates, and credit risk. It also explains the principles of arbitrage and hedging that LTCM adopted as strategies and are still used today. Here are key takeaways from LTCM downfall when genius failed. 1. Never invest in stocks of your employer. You may lose your job and savings together. Most of the employees of LTCM invested their savings and bonuses in the LTCM fund itself. They were happy to get an opportunity to invest in a fund which had stopped taking investors' money. They were happy to see their personal net worth grow initially, but got the shock of their lives when their job and savings vanished simultaneously. LTCM episode cautions salaried investors, while investing in stocks of their employers, just like previous episodes of Enron and WorldCom did. 2. Diversification does not help in crisis. Everything falls down simultaneously. A widely known belief is that diversified portfolios provide cushion during bad times, as it is highly unlikely that all the different investments will go down in value simultaneously. However, repeatedly, it has been proved that during a crisis, all the investment assets lose value together. It happened in 1987, repeated in 1998, again in 2002, 2008, and then in 2020. During such times, all the stocks go down together. LTCM learned the hard way that the statistical proofs of decreasing standard deviation by increasing the number of investments in a portfolio works best only in computer models. In real markets, the people decide prices, and when crisis strikes, it creates panic. During panic, investors lose rationality and everyone runs to safety by dumping every asset they own. Cash becomes the safest investment and everything else, including stocks, bonds, or real estate, is discarded. Result is widespread fall in prices of all asset classes. No wonder all 60 to 70 assets of LTCM lost money together. Successful investors have always considered diversification with a pinch of salt. Warren Buffett wrote to shareholders in his 1978 letter, "Our policy is to concentrate holdings. We try to avoid buying a little of this or that when we are only lukewarm about the business or its price. When we are convinced as to attractiveness, we believe in buying worthwhile amounts." 3. Investing is not pure science. IT requires common sense. LTCM assumed markets to be science and mathematics. Their managers believed to predict markets using computer models. However, investing is dealing with assets and companies managed by humans. People run companies, but somehow this fact is forgotten by investors. Many investors start assuming companies as mathematical models where a fixed amount of investment in assets or R&D would bring a fixed amount of return. People differ in performance day in and day out. Companies show vastly varying performances, many times for no apparent reasons. People decide the prices in the markets. People have emotions and they become euphoric and panic at unpredictable times. These behaviors take asset prices over the peaks and then down in troughs. Mathematical models cannot predict the timing of such periods and therefore they should not replace human judgment. Investing is more of an art where once the basic financial numbers are obtained, rest is dependent upon the investor's subjective judgment and common sense. 4. It cannot guarantee good returns in markets. An investor does not need to have an IQ of 150 to succeed in stock markets. If intelligence had a correlation with the results in stock investing, then LTCM, which had some of the most intelligent people alive on Earth, could never have failed. All the mathematics that an investor needs while analyzing stocks is the basics taught in school. The rest is her own judgment, experience, common sense, and gut to take decisions. Everyone, whether you or me, whether having finance background or not, has equal chances of doing good in stock markets provided one is willing to put in the required time and effort to read and analyze stocks. 5. Institutional investors are not always right. Seemingly smart money does act dumb many times. Many investors try to mimic the investment decision of large institutional investors or famous high net worth investors. LTCM episode is a glaring proof that no one is above errors. Investors who follow others do so at their own peril. It is advised that investors should invest in stocks only after doing their own research. Peter Lynch, in one of the best books on investing, One Up on the Wall Street, says that investing in stocks without doing own research is like playing poker without looking at your own cards. 6. Markets are irrational. One of the most popular theories prevalent today is that markets are efficient. Efficient market theory suggests that all the participants in the market have same amount of information and they all react to the presented information in the same highly rational manner. However, any investor who has an experience of few years of investing or observing or analyzing stocks would say that markets are not always rational. Stock prices move to extremes as market participants overreact to both good and bad news. Charlie Munger says that efficient market theory was devised by so-called experts, mathematicians who wanted to apply their knowledge to markets and therefore devised the assumptions, which let them apply their theories to market prices. Efficient market theory formed a perfect platform for such application of mathematics as happened in case of LTCM. LTCM managers assumed that markets are rational and whenever any change occurs, all the market participants would react in most rational manner and bring the prices to new rational level, which could be predicted by computer models. The fall of LTCM provides another proof that markets are made of emotional human beings who act irrational all the time. Market prices do not always reflect the rational levels and therefore provide many opportunities for keen value investors to achieve good returns. 7. Put only money you can afford to lose without going bankrupt. Stock markets are irrational and would always provide the investor with opportunities of investing in stocks, which are available at a discount to their actual value. Such opportunities present excellent wealth-generating avenues. However, markets may not recognize the aberration in pricing of these stocks immediately after an investor buys them. Moreover, there may be many months or years before a good-performing company with cheap share price is recognized by other market participants and its price increases in value. Markets are known to test the patience of investors with very long periods of inactivity. Such periods create feelings of frustration and self-doubt in investors and many times makes them take wrong decisions exact at precisely wrong times. Stock markets require patient capital and staying power. LTCM, with its huge equity of USD 4.6 billion, could not remain solvent during the time taken by markets to return to rational levels. The same can happen to individual stock investors as well. It is therefore advised that an investor should have an emergency fund and save money for other critical life decisions before she decides about investing in stock markets. 8. Leverage kills. Leverage seems exciting at the start as it turns overall mediocre returns on investments into formidable returns on equity. However, investors frequently forget that leverage is a double-edged sword. It pushes the return on equity during upside. However, it hammers down the same return on equity during downside. Many investors in the initial euphoria forget this basic premise and invest in derivatives like futures and options. LTCM managers learned the effects of leverage by paying up with their careers, social positions apart from personal investments in LTCM. Con investors also many times suffer heavy losses in derivatives. Investors should always avoid leverage while investing. Warren Buffett does not call derivatives weapons of mass destruction without reason. Warren has always advised Berkshire Hathaway shareholders and investors around the world to avoid borrowing for investing.